Hi, we're going to be doing problem M3-2 on page 123 and M3-4 on the same page. But before we do, I know you've already read. If you haven't, please stop right now, go back, read the chapter, or watch your interactive presentations, and then come back and take a look at this demo. But if you have already read, you might remember reading about the revenue recognition principle, which states that revenue should be recorded or recognized when they are earned, and they're earned when goods or services are delivered. If you're paid, if cash is received before goods or services are delivered, we still record an increase to cash. But since the goods or services aren't yet delivered, we can't record a revenue. We have to record an obligation to provide the goods or services. That sounds like a liability, right? It is. Unearned revenue is a liability. It doesn't have the word payable in it, but unearned revenue is the obligation you have to provide goods or services for which you've already been paid. If you've delivered goods or services and you can record a revenue, but you haven't gotten paid yet, well, then you can increase cash. You'll have to use accounts receivable, which is where we put amounts that our customers owe us. So let's take a look at this problem, M3-2 on page 123. It says the following transactions are July activities of Bill's Extreme Bowling, Inc., which operates several bowling centers. If revenue is to be recorded in July, recognized in July, indicate the amount. Okay, so the main question you're going to be asking is, were the goods or services delivered in July? If so, we record a revenue in July. In A, Bill's collected $12,000 in cash from customers for services related to games played in July. Well, we provided the services in July, so we can record revenue in July. There we go. In B, Bill's Extreme Bowling billed a customer. When we send a bill, that means that we didn't get paid. They sent a bill to a customer for $250 for a party held at the center on the last day of July. Bill's not going to be paid until August. Okay, remember the question is, did you provide the goods or services in July? Yeah, on the last day in July, but we provided them in July, so we get to record a revenue in July. You're not going to get paid till August, but you earned it in July, so record the revenue in July. In C, the men's and women's bowling leagues gave Bill's advance payments totaling $1,500 for the fall season that begins in September. So you're getting paid in July for services you're not going to be providing until September. We can't record any revenue in July because we didn't do any work or provide any goods or services in July. We're going to provide those in September, at least beginning in September. So we can record an increase to cash, but we cannot call it revenue. And then finally in item D, Bill's Extreme Bowling received $1,000 from credit sales made to customers last month in June. The question here is, did you provide the goods or services in July? Nope, they were provided in June. So you're not going to be recording any revenues. Now, you will be recording a receipt of the cash, but remember they're asking you here about revenue only. Okay, let's check our work, see how we did. And we did a great job. Okay, let's go on to the next problem in which we'll be recording revenues using journal entries. Okay, we're going to be recording the same transactions we talked about, but using journal entries, recording them into our accounting records. All information gets into our accounting records through journal entries. Okay, so in the first one, we collected $12,000 from customers for services related to games that we played in July. And we said that we should be recording $12,000 worth of revenue. Okay, so remember every journal entry, every transaction involves at least two accounts, sometimes more. Okay, let's picture what's happening. The collection of money and people playing bowling games. Okay, so if we're collecting money, let's name the accounts involved. We should record cash being received. and we should be recording money earned for delivering goods or services, and that's a revenue. Cash is an asset. It's on the left side of the accounting equation, so we increase on the left or debit side. Debit to cash for $12,000. Now we're going to be crediting, I guess ideally it would be bowling revenue, but they just have us using the account called service revenue, not very specific. We're going to be crediting it. Why would we credit it? Well, let's remember that revenues and expenses, revenues minus expenses specifically, is how we determine how much net income we make. And net income is essentially our earnings. Remember that retained earnings account? It's all the earnings, previous earnings, less any that we gave away, and that's our balance in our retained earnings account. Eventually, our net income is going to end up in that retained earnings account. So our revenues and expenses have to follow the same rule that you would use, debit and credit rule, as you would for retained earnings. Well, retained earnings is a stockholders' equity account. Increases in stockholders' equity are recorded on the right or the credit side because it's on the right side of the equation. If revenues increase net income and retained earnings, then we're going to have to record it on the right. You can remember it this way. Revenues recorded on the right. 3 R's together. R, R, R. Okay, so let's record that. In B, Bill's company billed a customer, sent a bill for $250 for a party held at the center the last day of July. It's going to be paid in August. Well, remember the question is, did you earn the money in July? Yes, we did. We can credit service revenue for what we earned in July because we did the work. Revenues are recorded on the right. They increase net income. Consequently, they increase retained earnings, so we have to follow the stockholders' equity rule of recording on the right. Now, you can't debit cash to increase cash because you didn't receive cash. We are going to record an increase in accounts receivable, which is where we put the amounts our customers owe us. So our journal entry is debit accounts receivable, credit service revenue. Every journal entry has at least one debit and at least one credit. Entry C. The men's and women's bowling leagues gave Bill's advance payments. You got cash ahead of time, $1,500 for the fall season. We said no revenue should be recorded. That's true, but that doesn't mean you're not going to record the cash you received. Cash is an asset. Assets are on the left side of the accounting equation, so we increase cash by putting amounts on the left or debit side. But we can't call it revenue. We're going to call this unearned revenue. And this is a real tricky account because you think it's a revenue account. It's got the word revenue in it. But revenue is not revenue if it's not earned. This is a really bad name for an account. It's what we call an oxymoron when the two words together don't make sense. If it's not earned, it can't be revenue. This is actually a liability account. It doesn't have the word payable, but it's a liability. You owe your customers the right to bowl because they paid you already. Okay, so the credit is to a liability account, unearned revenue. And then finally in D, Bill's Extreme Bowling received $1,000 from credit sales made to customers last month. We won't be recording revenue for it this month because the money was earned in June. They bowled in June. They're just paying you for bowling that already took place. So if we received cash, cash is an asset. We left side or debit to increase assets because they're on the left side of the accounting equation. And we're not going to credit a revenue because it would have been credited last month. What we're going to do is reduce accounts receivable. Reduce the amount your customers owe us because they're paying us. So we're reducing their debt. So those are our journal entries to record the revenue transactions. The next problem we're doing will demonstrate how to record expenses.